what we saw so far this year is, for example, stock multiples, earnings multiples on stocks have compressed pretty significantly. As you've seen an unusually strong spike in rates, you've seen a sell-off in bonds, sell-off in stocks. Um, and the question going forward is, okay, if rates are topping out, maybe the valuation pressure is done now
Mm.
on some of those companies. But then the question becomes, what's going to happen to their earnings side if we do encounter either a recession or some type of near recession type of environment. And so, I think there's certainly a way to play a top in rates. It could be a bounce in gold. It could be a drop in the dollar. It could going long on some of these treasury positions. I think there's multiple ways to play it. So some of the winners of the first half of the year, dollar straight up and many other assets straight down. I think you could see somewhat of a reversal for some of those potentially. As one measure, you can look at, say, household net worth as a percentage of GDP. And so the higher that is, in some ways, the more financialized that economy is. And so, in the dot-com, obviously during raging bull markets, that'll hit a peak, and then during bear markets, that'll be lowered. So historically, it's been some reasonable multiple. During the dot-com bubble, you got up to almost 4.5. So household net worth was 4.5 times as high as GDP, roughly. Then, of course, that came down significantly. Then it went up again in 2007. But instead of, in 2000s, it was mostly in stocks, not really in real estate. In 2007, you had the opposite, where it was not a very euphoric time for stocks in general, but it was very euphoric for real estate. And what we saw going into this year was it got all the way up to over 6. And so both stocks and real estate and bonds and everything was super high relative to GDP. And so that's a quite financialized situation, because if you have a big contraction in asset prices, you're going to get a number of factors. One is you're going to get, the top 10% or so are the biggest consumers. And if if their net worth is evaporating, they're not going to, they're not on the margin, they're not going to be, putting pedal to the metal in terms of things they want to buy. And then also, you're likely to get more turbulence in tax receipts. Generally, there's a very strong correlation between the stock market in year-over-year terms and tax receipts in year-over-year terms. And so in general, I think that the market is very financialized. I think that the tail's gotten so big that it can wag the dog. And so I think that's part of, kind of the softening that we've seen. And it also makes it's challenging to keep some of the markets liquid when they have that happening. So disinflation for people is different than deflation. It means that the rate of inflation is going down. And one thing I've been emphasizing for a while is that even though I think this is an inflationary decade, that most inflationary decades have periods of disinflation within an inflationary decade. It could be for any number of reasons. Maybe, in some cases it could be because the supply side issues is getting temporarily addressed. Sometimes it's because the Fed or other central banks are fighting back and trying to curtail the demand side, which is what we're mostly seeing right now. And so I think what we're seeing right now is basically an attempt to hold the beach ball underwater in terms of inflation. So it's do we have more refining capacity? No. Do we have materially more oil and gas production? No. So I think a lot of the underlying issues, that some of the inflationary pressures are still there. But I think that if you do curtail demand enough, if you seize up the housing market, which is generally what we've seen happen, if you do get a little bit more labor weakness, which we're starting to see materialize, then you can start to get disinflationary pressures. And so, for example, if oil went straight up, if that goes sideways for a year, right, that's zero inflation from the energy side. I'm not saying it's going to happen. I'm just saying that's how you can think of it, where you can get a period of low inflation just because things that went up in price a lot can plateau for a period of time until whatever the next round up is. So I think that politics has become more gridlocked and is likely to get more gridlocked after the elections. And so I think it'd be challenging for them to pass sweeping things. But I think you could see more targeted types of stimulus, things that helping people of food and energy, right? That sort of thing. So their prior stimulus, right? People could go and take it and buy Dogecoin with it, right? So, which is not exactly what they were intending. So I think that you could see, we're already seeing out of Europe and some states. They do things like, they'll take the tax off of energy, or they'll give people specific energy stimulus. I think you could see more targeted things like that, especially if you get, ongoing negative sentiment, donors calling out the politicians and be like, hey, things are not great. What are you going to do about it, right? So I think you can eventually get some sort of response, but I think it'll be more of a grinding period going
Yeah.
forward. I think we expect probably more overall stagflationary type of conditions. And I my kind of base case is that the stock market capitalization to GDP, I think we've probably seen the highs for quite a
Mm-hmm.
while. And that does not mean, I mean, you could get higher nominal S&P 500, for example. You could get, basically you could keep grinding up in nominal terms. But I think that the asset prices relative to the economy, I think there's a good case to be made that that period of zero rates, COVID response, biggest ever liquidity injection in modern history. That might have been the kind of a pretty significant peak in terms of how financialized we are. And I think going forward, I think we're going to have higher average inflation, but again, disinflationary periods within that higher average inflation. And I think it'll be challenging for asset prices to get as high as they did, at least relative to GDP. One of the big things that happened during the past couple of years is, in addition to a surge in demand, people also had a rapid shift in what they demand. So everyone was locked down, and they said, "Well, let me buy a home and remodel it, or let me get a bunch of electronics or subscriptions." And that's really hard for goods. I mean, the supply chain can only support so much at one time. And you had a chip shortage. Basically, I think some of those specific factors, yes, I think that many of them already are easing,
Right.
and I don't think we're going to see such a rapid one-time change again. And so some of the congestion of supply chains at that peak level, I think there's a good case that's behind us. I
Mm.
think you could get disinflation in, your ability to get many types of goods. Um, for me, the more persistent inflationary pressures are on the energy side. I
Yeah.
think that the supply response on energy is low, both in terms of production and then also refining capacity and transportation. And there's more frictions in general. I mean, if Europe has a severe natural gas crisis, they now have a very strong response to go out into the world and figure out how to get more other types of energy sources to bring
Mm.
down that. And that there's a natural response there. I mean, if you're a North American gas producer, you have a desire to build some LNG terminals and get them over to Europe because you'll get a much bigger spread on your product, much higher natural gas prices there, for example. And it becomes more economic for Europeans to burn other types of energy sources in lieu of natural gas. So it can bring up oil and coal and wood, things like that. And so I think that with that kind of hole in the global energy infrastructure, I think that this is an ongoing issue that's not going to be resolved quickly. I think that there's short-term types of oil like shale, and they can be brought online pretty quickly. You can get kind of these flexible responses. We actually haven't seen a ton out of that, but at least it's possible to ramp that up pretty quickly. But in order to truly bring more supply to market, some of those bigger projects, like offshore projects and things like that, have to be done, which means that an entity has to be able to look out, 5 to 10 years and be confident that they're going to make a return on capital,
Right.
both in terms of oil prices being high and in terms of jurisdictions not, changing their rules or taxes around what that company can expect. And so I'm not seeing much supply response really broadly in energy markets. Of course, around the margins, there's always supply response, but I see nothing that indicates this is anywhere near over yet.